The married put, which we advocate here at Power Options and at Radioactive Trading, is the proper way to ensure your stock positions, to control risk in unknown markets, ensure your portfolio positions, and leave the upside open. We've had recent discussions with you on where are we headed next? How can I trade in the market if I don't know where the market is trading next and still come out ahead? The proper structure of the married put setup and how that benefits you, and the advantageous hat trick for locking in unrealized gains. But can the married put really help your trading? Why pay to control risk long term? Why not just buy and hold? Why not use covered calls, which are a popular trading strategy and a popular way to hedge stock positions? Why not use a free stop order? Is it worth it long term? Let's take a look at the tale of two stocks, two underlying stocks, both alike in technicals and successful 2023, where we lay our capital. Dell Technologies, July 13th, 2023, stock was trading at $55.33. On December 29th, stock closed at $76.50, a gain of $21.17 per share, or 38.3% over a 5-month period. Fantastic. FTNT, Fortinet, July 13th, 2023, Lucky Sevens at $77.77. But after a rough couple quarters, December 29th, the stock is standing at $58.53, a loss of $19.24, or 24.7% of what we would have invested in the position. If we had allocated 100 shares to each in a $15,000 portfolio, right now we'd be standing on a gain of $193, or just 1.3%. Meanwhile, with the last run-up we've had in the S&P, it's up 23% essentially at the end of the year for 2023. Let's look at Dell from early July. Around the time we might have entered this trade, as it appeared on the married put default search, we have a stock that's trading above the 20-day moving average, was flirting with the upper Bollinger Bands, and had a somewhat positive MACD, though it was wavering a little bit. Was it a bad idea to buy at the top? Well, only until you see the next tops, and the next top, and the next top as well. Similar structure. Fortinet, FTNT from early July. Stock again above the 20-day moving average and the 50-day, of course, flirting with the upper Bollinger Bands, positive MACD trend, which is more pronounced, but a little bit of a different story. A sudden breakdown here, and we see from about 74 down to about $60 per share. Naturally, that was an earnings surprise. And we see some gain back in it. 3 quarters later, another decline as well. 3 months later, my apologies. And then it's starting to gain back up. However, looking at this trade, you can see how the stop orders would not have helped you. Remember, that's just assumed insurance. If I put a stop order at 5% or even a trailing stop, went through that earnings, the stop got down to $59, $60 per share. Remember, that stop order just becomes a market order to close you out. Hey, I want it to be closed out at 72, around that 5% range from where I bought it. But now the stock opens up at 58. What happens? I get closed at 58. The market can't give me the $72 or $73 back. I still realize that 23% loss, and now I have to make it back as well. But it started off with the same types of technicals, the same types of trends, but the forward-looking aspect didn't prove to be profitable. And here stands our two stocks, as I mentioned. Dell on July 13th, purchasing at $55.33, close at $76.50. We're up $21.17, or 38.3%. Fortinet, with its downs and slight ups, purchased at $77.77, currently at $58.53, loss of $19.24, or 24.7%. Total in the portfolio, we still would have been sitting on about $1,600 in free capital. The portfolio total is $15,193, so we're only realizing that 1.3% return, even with one stock gaining almost 40% in a 5-month period. What if at the same time we properly protected both trades? following the proper married put structure discussed in the blueprint at Radioactive Trading. Would we be better off? Let's take a deeper look. Following the criteria in the blueprint and the default search results on July 13th, we would have seen a structure to buy Dell at $55.33, just as we would have purchased the stock. At the same time, we could have bought 2024 January 57.5 puts at $5.45. Hey, we're paying an extra 10% premium above the stock price to make our total invested $60.78. But we have a guaranteed exit of $57.50, so the worst possible scenario, even if Dell fell to $10, $15, or $20 per share, is we could only lose $3.28 total, or 5.4% of what we invested into the position. And we could have done something very similar with the Fortinet position, which was also on the default married put search and power options in mid-July. On the 13th, we could have bought Fortinet at $77.77, and we could have bought 2024 January 80 puts at $7.60. Now, there's that 10% increase in price again to make a total invested of $85.37. But we've guaranteed an exit, unlike a stop order which can be violated, where we can get out of the stock at $80 per share, even if the stock's trading at $55, $58, $20 per share. So the most we can lose is $5.37, or 6.3% of the capital invested. And a closer look at where those positions would stand right now. Same entry date, same entry price for the underlying securities. On the Dell position, naturally the put has declined in value significantly. But we still have left the upside open. We still have a profit on the Dell position of $1,577, or 25.9% of our invested price. Meanwhile, with Fortinet down $19.24, a decline of about 25% in the underlying security, the put option increased in value for us. So if we liquidated the position right now, we're only at that loss of $544, or roughly 6.4%. Kept most of the profit on the position by leaving the upside open, didn't lose nearly as much, and controlled risk to single digits. So now with the married put structure, we're looking at a total portfolio value of $16,033, a profit of $1,033 of a $15,000 portfolio, or 6.9% return in 5 months. Well, let's table that. 5 months into the two trades. Stock only is a total profit of 1.3%, or 0.26% per month. Dell, $55.33 to $76.50. Monetary gain of $21.17, or 38.3%. An average return of 7.7% per month. Fortinet, almost flip a coin and reverse it. Original price of $77.77. Current price of $58.53, a loss of $19.24, down 24.7%. Average monthly losses 4.9% over that 5-month period. But the totals for the portfolio, purchasing both stocks at the same time, we would have invested $13,310. $1,690 is left in free capital. And if we used that to buy 5 or 10 more shares of Dell and 5 or 10 more shares of Fortinet, we still would see the same sort of profit on the positions. But the current liquidation value, if we close both stocks, is $13,503. So with the money invested, we only profited $193. Or for the 5-month period, 1.3% total on the $15,000 starting point, which comes out to be 0.26% per month, probably below your goals for trading. The preferred married put structure, same time frame, same underlying price, but adding the proper protection to cut losers short and allow the winners to run. The Dell plus the put, total purchase would have been $60.78. Current value, with only 5 or 10 cents remaining on the put, is $76.55. We still have a gain of $15.77, less than the $21.17 we would have seen in the stock. but we still make 25.9%, pretty much 70% of the 38.3% we would have realized just owning the stock. An average return per month is 5.2%. Now, the Fortinet position, we would have allocated a total of $8,537. But the current value is $79.93. It would be 80 and it should be 80, but because of the bid-ask spread of the put, it's offering a little bit below intrinsic value. That's okay, we'll count it. We'd get 80 back for it if we exercise the put, but we'll leave it at $79.93. A loss of $5.44 per share, or $544 total, on a stock that's down $19. Loss on that position is only the 6.4% that was guaranteed, or loss of 1.3% per month. Totals, at the beginning on July 13th, we would have allocated $14,615 to our two married put positions, leaving $385 in free capital. Current liquidation, $15,648, still holding that $385, so the total portfolio is $16,033. Profit, $1,033, or $1,033 in 5 months, 6.9% of what we invested total in the portfolio, that $15,000, or 1.38% return per month on average. I might say big deal, a 1.3% return per month. Would have done much better just buying SPY. Possibly. But that's 16.6% per year roughly. That's within the target goals of any hedge strategy. Whether you're talking about married puts, whether you're talking about standard collar positions, whether you're even talking about naked puts or covered calls. And this return does not include any income methods that we can use against the married put structure to further lower risk, generate income, lower cost basis, and more. It's just a straight comparison. But isn't it better to generate income? Of course it is. That's why we have 12 different income methods in the blueprint. But let's talk about income generation. Let's talk about renting out our stocks and collecting premium rather than paying for insurance and adding extra cost basis. A lot of investors say that covered calls are the best hedge out there to rent out your stocks, generate premium. I want to sell an out-of-the-money call, just gain 1.5% per month in time premium, let it expire, and just keep doing that to increase my returns, increase the dividend payments, and more. The structure of the covered call does the opposite of what the married put does, and opposite of what every trading guru has said through the years. Covered call structure cuts your winners short and lets the losers run. Now, what we did here is we took the Power Options Strategy Optimization Service, where we can create a basic search and have a computer system just run that search criteria over the course of 5 months, 10 months, 2 years, 3 years, what have you. We created a search for just Dell and Fortinet individually. We selected to look for the next expiration cycle, one strike out of the money. No stops. If the stock was above that, we took assignment, realized the full return, rebought the position the following Monday after standard expiration. And how did they perform? Well, Dell was up, as we saw, 38.3% for the year. With the out-of-the-money covered calls, we took $7,500 to allocate to 100 shares of Dell starting on July 13th for a covered call position. And after 5 months, 5 trades, we have 4 wins and 1 loss. And the ending portfolio value was $8,220. We gained $720, 9.6% on the $7,500 investment to this portion of the covered call portfolio. Now, the minimum account value was only $74.58, so we didn't see much losses. And the max was a little bit higher on 12/14 before we gave a little bit back right before expiration at $82.91. But the ending amount, December 15th, final expiration, gain of $720, or 9.6% of the $7,500 invested for 5 months in covered calls on Dell. But then we have our different story. We cut some of our winners short, which we just saw. But the covered call structure still lets those losers run. Now, 9.6% for Dell in 5 months is pretty great. The stock was up 38.3%. On the Fortinet position, even generating income for 5 months, 5 total monthly covered calls just out of the money. We started off with $7,500. The ending cash on hand is $5,761. We're still down $1,739, or 23.2% of what we invested into this position. And of course, the lowest amount on November 7th was $5,423, a much bigger drop than 23.2%, and had just a little bit of profit only of $66 on August 1st before some of those declines. It's an improper structure. We have one winner, one big loser. The winner was bigger than the loser, but in the structure of cutting the winner short and allowing the losers to run, we have an improper hedge over a total portfolio. Breaking that down into the two different positions. Dell is up 38.3% since July. Fortinet is down 24.7%. Allocating $7,500 to each trade, we generate premium on both, but we cap the upside on Dell. We still have a profit. $722 as the ending portfolio amount was $8,220. Well, that's a gain of 9.6% against the $7,500 invested, or 1.9% per month. Hey, better than we saw with the two married put structures. However, Fortinet is down to $5,761 total value, a loss of $1,739, or 23.2%. Even generating income against the position, we're still down about 90% of the stock decline. We're averaging a loss of 4.6% per month. Totals combined allocated $15,000 to 2 covered call positions. Current portfolio value is $13,981. That includes extra capital on hand that was not used in the trades. The portfolio is down $1,019, or 6.8% of the starting basis of $15,000, for an average loss of 1.36% per month. So is the covered call strategy a good hedge? Income was generated to reduce cost basis and to potentially reduce loss. But on the flip side, the gains were capped. We only realized 25% gains on the winner. We had a 9.6% return compared to a 38.3% return in the underlying security. However, that 1.9% average return per month is what we'd expect with covered calls, kind of the target. But we fall prey to the structure of the trade, where we still realize 93% of the losses on Fortinet with income coming in. Is that the proper hedged position, or is it an improper structure? Basic net comparison. Stock, popular covered calls, proper protected put positions. With our two different stocks, a tale of two different stories in 2023, the last 5 months, the stock-only return allocating roughly the same amount to the two positions was a total gain of only $193, or 1.3% of $15,000 portfolio, 0.26% return per month. A covered call, because of the structure, we realized that loss of $1,019, or that 6.4% against the $15,000 portfolio, loss of about 1.3% over 5 months. What is the proper structure of the married put, allowing more of the winners to be realized in Dell over the covered call structure, and controlling the losses in uncertain markets and unknown events for Fortinet. We have a profit of $1,033, or 6.9%, or a return of 1.38% per month over a 5-month period. Just another quick review again. The stock only. Well, we allocated $13,310 into the two positions on July 13th. $1,690 was left in free capital. The ending amount was $13,503, the 38.3% gain, $2,100 in Dell, and the 24.7% loss, $1,924 in Fortinet. This leaves us a profit with $193, Against that 15,000 total portfolio, 1.3% return, or 0.26% over 5 months. Covered calls, we allocated 7,500 to each one in the strategy optimization tool. Not all of it was used, but however, including the cash on hand that was left over, the ending portfolio value just out of the money covered calls over a 5-month period is $13,981. A loss of $1,019 or 6.8% loss against $15,000. Roughly 1.36% decline per month on average from July to December. With the married puts, the stock plus put combination would have cost us more. We would have allocated $14,615 to the Dell married put and the Fortinet married put on July 13th. Ending amount on the securities is $15,648. That's our gain of $1,033. You add in that $385 that we had lying about extra, that puts the portfolio at $16,033. We have a 6.9% positive return on $15,000 portfolio size, or an average of 1.38% return over the 5-month period. And remember, that's just the straight married put structure. We did not include any income methods discussed in the blueprint to generate income, lower the cost basis, bulletproof the positions. Just straight married puts compared to owning the stocks and compared to the covered call structure. So how do we win in the market? Is it about timing trades? Finding the perfect time for entry and exit? Is it the structure of the trade, the popular let's generate income weekly or monthly with covered calls or naked puts? Well, I think we've seen the answer. It lies within the proper structure. To stay in the game in uncertain markets, uncertain outcomes of earnings surprises and other events, we want to enter a position that guarantees we cut our losers short and allow the winners to run. This is what the married put structure does, and this is what the full course, the blueprint, details. The full concepts on how to properly limit risk in the proper married put structure to control risk to single digits, even in declines of 25, 35, 40% on your stocks or in the market in general. Full details on the 12 different ways that we use to generate income against the position, manipulate the put option, that second working asset in the proper married put structure, to further lower risk and potentially bulletproof the trades. Full chapters on combining income methods, when to exit the married put, a full appendix, examples, and much more. We're uncertain going into 2024, even though we've had a lot of investor optimism at the end of 2023, and a lot of expectations for how the year might have ended have been exceeded. But with a straight comparison, the structure of the trade, is it the timing of the trades? I think we've seen clearly here, we want to protect our positions. We want to protect our unrealized gains, if we have any, on the securities that have moved up in price, rather than use the improper structure as a hedge, or rather than just buy and hold and hope for the best in a basket of stocks going forward. And now is the best time to start getting the full course, start controlling risk properly, and have full education on all 12 ways to further generate income in that limited risk structure, further lower the risk in the cost basis, potentially bulletproof your trades, and more. If you pick up the blueprint before midnight on December 31st, before we change over to 2024, you're going to lock in these special 8 bonuses in addition to the educational materials that can save your portfolio in 2024. You're going to receive a coupon to get 2 discounted months of the Fusion subscription for only $10 per month. You're going to receive one of our Mastery Series videos, The Foundations of Radioactive Trading, or Forts video, usually $89, for free. We're going to send you an additional video, The 4 Insider Secrets of Trading, as well. You'll have access to the quick start guide right away to help your transition into the married put structure, opening positions and searching for positions, which is also detailed in full in the blueprint. We're also going to give you 1 month of power options for free, and that starts at any time. It doesn't start right away. It starts when you're ready. The blueprint is now an all-electronic copy, so you'll get instant access when you place your order to start going through the materials. And of course, we're always here for you via email or by phone call, coaching sessions, and more to talk you through the setup, the income method questions you might have, management, a second set of eyes on your positions, and much more. You'll also have instant access to members-only content, Blueprint owners-only webinars, other materials, white papers, and more. But remember, these bonuses will expire on December 31st at midnight, so you want to make sure that you act soon. Take advantage of the 8 special bonuses for our end-of-the-year promotion. But most importantly, start learning the proper structure to control risk, to stay in the market, and see profitability when you're comparing different baskets of stocks, the ones that succeed and the ones that don't as well. Check out the blueprint, lock in your bonuses today, and we'll see you in protected trading in 2024.